Good day, everyone. Thank you for joining us once again here at Seaford & Brew for our economic briefing. For this briefing, we're going to review over the performance of the Community Bank Benchmark Group for the second quarter of 2021. So overall, if we remember, this group is made up of banks with assets between $100 million and $5 billion. Overall, we always like to break down this group into three primary categories: the sub-S banks, stock banks, and mutual institutions. And overall, we can see with the return on average assets for the second quarter, the mutual and stock groups remained basically the same quarter over quarter. Stock group at 1.09 and the mutual group at 66 basis points. That subchapter S peer group section came down just 3 basis points from a 149 down to a 146. So collectively, we've seen slight movements in the ROA. When we look at it as a group in its entirety, we have that return on average assets dropping just 1 basis point down to a 1.17%. When we compare it year over year, though, we're up 7 basis points. So overall, continue to be very strong. When we look at the net interest margin, and we expected this to continue its downward trajectory, coming down just 3 basis points quarter over quarter down to a 3.34. So this is for the entire benchmark group. So that's all those institutions between 100 million and 5 billion. So this downward trajectory continues. We anticipate that to be the case moving forward. And why is that? Well, we know the components of that net interest margin include that yielding earning assets and cost of funds. And overall, we've seen additional headway in the cost of funds coming down about 5 basis points quarter over quarter, down to that 32 basis points. Now we're getting down to historic lows when we're talking about these types of rates. And we don't have much more to go. We do still have some CD specials from a year or two ago that need to be repriced throughout the remainder of this year. So we will have some relief on that end, but for the most part, all those non-maturity deposits, those cash type deposits, have repriced down, so that ability to capture additional benefits from reductions of deposit rates is nearing its end. However, when we look at the yield on earning asset, that continues to move down by 7 basis points this quarter from that 372 to a 365. It is expected that to continue its downward movement as we see rates that continuing to be this low. In fact, throughout July into August, we've seen that a 10-year Treasury get down into the 120s. In fact, it dipped below 120 at a couple of points. This morning, back up to a 128 with a positive employment report. So that's good, but even at that level, those assets that are rolling off are repricing at lower overall yield. So this natural progression of a lower yield earning assets is going to continue as we move forward. That coupled with the fact that we still have a rather large position in cash. When we look at the distribution of assets for this benchmark group, we can see that cash position, that interest-bearing cash balances, is at 11.11% of overall assets. Now that compared to where it was back in the second quarter of 2019 at 6.13, in the second quarter of 2018 at 5.55. So overall, when we look at it, we start doubling the amount, almost doubling the amount of cash on our balance sheets. And of course, that is not rendering a great interest rate. We're, low double digits, maybe even single digits on those balances. So that's going to impede, again, the ability to increase that net interest margin moving forward. And that being said, that's the case even if we do see that long end of the yield curve begin to pick up once again. We look at the forecast in terms of the Bloomberg consensus. For year end, we're looking at a 10-year treasury on average to be about a 180. We have also PNC and Wells Fargo. PNC 5 basis points lower than that consensus at a 175. And then we have Wells Fargo continuing to put out there that 2% yield on that 10-year by the end of the year. I'm still skeptical that we're going to reach out that far. I don't think we're going to get up to that 2%. A 175 in my mind is more of a probability than that 2%, but I think it's going to actually be lower unless we start to get really strong economic numbers coming out and COVID, that the recent COVID surge because of the Delta pulls off. I don't think we're going to get back up to that 2% range by the end of the year, even if we do see stronger economic numbers. I think that's a little bit of a stretch. My bets would be to be a little lower. And we have to think about how that's going to impact that overall level on the yield on earning assets. Now, that being said, even if we were to reach that 2% yield on that 10-year treasury, I still think there is room for the overall level of interest rates on the balance sheet, those yields on those assets, to move down as they reprice. We continue to have the repricing of that cash flow. And this is the long end of the curve. The short end of the curve, where we have that cash balance, almost 10% of the balance sheet, isn't expected to move all that much over the next 2 to 3 years. And that's going to, again, weigh down those overall level of yield on that yield and earning assets. So that's going to be the reason that I'm thinking we're going to continue to see that downward trajectory on the net interest margin over the next 12 to 18 months. That being said, efficiency is going to be key in order to maintain these higher levels of return on average assets. Overall, the Community Bank Benchmark Group has done a great job in reducing down its net overhead from a 185 in the second quarter of 2020 to that 171 in the second quarter of 21. So very strong. Historically, we would say banks should be under 2%, and a very efficient institution would be under 175. So overall, that's changed, and a lot of that is because of the additional cash that we had coming in because of the stimulus, because of the PPP loan programs that has helped that denominator in this calculation, that average assets, to really reduce down these numbers. When we look at the components in the net overhead, we have the non-interest expense and non-interest income. We've made headway. We're down to that 237 on non-interest expense, and for the non-interest income, up to 55 basis points. So for the most part, when we look at the opportunities right here, so we see the non-interest expense done a great job in reducing down these non-interest expense levels over the course of the last year. We're going to continue to see that happen, I believe, as we move forward, as banks just continue to get more and more efficient. Now, we look at, what about that risk? We really haven't seen the overall level of risk with our risk index pick up too much. In fact, year over year, we're down slightly. What we do like to see, we like to see banks typically in this area, so we know we're still elevated when we look at across history, but right underneath that 50 mark, in that moderate zone, is where we're seeing banks right now. A lot of the risk that is being built up currently is in that earnings at risk, that sensitivity of your net interest margin. And that's where we see this risk spike. Once we get that under control, we'll see those risks come back down. We have been able to sidestep that credit issue that we, this time last year, we're really anticipating that to be an issue, but we've been able to sidestep that for now. The question is, as we move forward, we begin to see some of the stimulus money trailing off, how is that going to impact the overall level of that credit component? And hopefully we won't see that uptick in the credit risk over the next 12 to 18 months. But that's what we have for you today. Thank you for joining us once again here at Seafried and Brew for our economic briefing. Have a great weekend, everyone.